Foreign banks facing headwinds in mainland China, profits decline for global investment banks. According to recent reports in the UK's Financial Times, 2022 has been a challenging year for the 7 investment banks established by Wall Street and European financial companies in mainland China. The article titled Global Investment Banks Declining Profits in China states that Credit Suisse, Deutsche Bank, Goldman Sachs, and HSBC reported losses in their China operations, while Morgan Stanley experienced a decline in profits. Only JP Morgan Chase and UBS achieved profit growth. This is a complete reversal from the optimistic atmosphere of 2021. In that year, after years of losses or meager returns, 6 out of the 7 investment banks finally turned a profit. Among them, Morgan Stanley, the first Wall Street bank to establish an investment banking partnership in China, in 1995, reported a profit of 30 million Chinese yuan, approximately $4.5 million in 2021. In the previous 3 years, its investment banking business in China had incurred a total loss of around $38 million. Therefore, despite the intensification of competition between China and the United States in 2021 and the emergence of significant unfavorable factors such as the Chinese Communist Party's strengthened regulation of industries including technology, real estate, and education, they still express the sentiment, "We must endure and continue moving forward because the opportunities are immense." Unexpectedly, 2022 brought about a series of challenges for foreign banks in China, including a major resurgence of the COVID-19 pandemic, Shanghai lockdowns, economic turbulence, the Russia-Ukraine war, escalating tensions in the Taiwan Strait, and intensifying U.S.-China confrontations. As a result, the operational performance of foreign banks in China mostly declined. Instead of opportunities, they were faced with more traps. Borrowing a phrase, one could say that 2022 was the worst year in the past decade but the best year in the next decade. The Financial Times attributes the significant decline in profits for the 7 investment banks in 2022, as well as the shattered hopes of finally achieving profitability in their China operations, to COVID-19 lockdowns and geopolitical tensions. However, this explanation is far from sufficient. It completely overlooks the arduous journey, failed breakthrough attempts, and the underlying profound reasons for foreign banks' struggles in mainland China over the past 4 decades. This article briefly highlights 3 points on this matter. One of the reasons, strict financial control by the CCP has limited development space for foreign banks. China's financial system has 2 major characteristics. Firstly, it is extremely bank-oriented. By the end of 2022, the total assets of financial institutions in China amounted to 419.64 trillion yuan, with banking institutions accounting for 379.39 trillion yuan, or 90% of the total. The total liabilities of financial institutions were 382.33 trillion yuan, with banking institutions accounting for 348 trillion yuan, or 91%. Secondly, the government, rather than the market, plays a decisive role in the allocation of financial resources. This is evident in 3 aspects. 1. Major financial institutions, such as commercial banks, are either wholly or partially government-controlled, and the government exerts significant influence over their operations. 2. The majority of financial resources are allocated to state-owned enterprises, SOEs. In 2017, SOE debt accounted for 74% of non-financial corporate debt, and loans to SOEs accounted for 54% of loans to non-financial enterprises. 3. The pricing of financial resources is not determined by the market, and capital account liberalization remains limited, indicating a relatively closed system. In such a financial system, the survival space for foreign banks is inherently narrow, and their advantages are difficult to leverage. In comparison, foreign-owned industrial and commercial enterprises in China have a larger playing field due to relatively greater freedom. Another factor, the undercurrent of foreign bank institutions exiting China. Another factor, the undercurrent of foreign bank institutions. In December 2022, Citibank announced on its official website the initiation of the process to close its personal banking business in China. The closure of Citibank's personal banking business in China includes services such as bank cards, mortgages, personal loans, deposits, investments, insurance, and foreign exchange. As early as April 2021, Citibank had announced its plans to restructure its global personal banking business, aiming to concentrate resources and investments in more competitive and scalable operations. In March 2022, after 27 years of operating in China's banking and financial sector, the Beijing branch of ING Bank, a Dutch bank, was closed. Prior to that, the Shanghai branch of ING Bank had officially closed in late September 2021. In February 2022, Standard Chartered Bank announced the closure of all channels for credit card applications. Currently, it is not possible to apply for Standard Chartered credit cards online through the bank's official website or official WeChat account, suggesting that this measure has shifted from temporary to permanent. In fact, as early as 2013, the Royal Bank of Scotland and Deutsche Bank had already closed their retail businesses in China. At the end of 2016, Australia and New Zealand Banking Group, ANZ, announced the sale of its retail and private banking businesses in China, including Hong Kong and Taiwan, as well as Singapore and Indonesia, to DBS Bank. These figures indicate the challenges foreign banks have faced in their operations in China over the years. According to data from the China Banking and Insurance Regulatory Commission, CBIRC, from 2007, when the data for foreign commercial banks' proprietary accounts began, until early September 2022, a total of 329 institutions have applied for withdrawal. Starting from 2016, there has been a peak of withdrawals. The number of institutions that withdrew from 2016 to 2021 were 42, 48, 49, 37, 39, and 37, respectively. In the first 3 quarters of 2022, 19 institutions exited, and only 7 new institutions were established. In 2021, there were only 11 newly established operational institutions by foreign banks in China, while the number of withdrawals was significantly higher than the number of additions. On March 18, the vice chairman of the CBIRC, Cao Yu, stated at the Global Wealth Management Forum 2023 that over the past decade, the assets of foreign banks in China have grown by 58%, and the assets of foreign insurance companies in China have grown by 552%. As of the end of 2022, foreign banks had established 41 foreign-funded legal entity banks, 116 foreign bank branches, and 135 representative offices in China, with a total of 911 operational institutions. The total assets of foreign banks in China reached 3.76 trillion yuan. Foreign insurance institutions had established 68 foreign-funded insurance institutions and 79 representative offices in China, with total assets of 2.26 trillion yuan. Compared to the early stages of development, both the number of foreign bank institutions and the absolute scale of their assets have significantly increased. It is true that the market share of foreign banks in China, measured by their proportion of total banking assets, has declined according to data from Fitch Ratings. As of the end of 2021, their market share had dropped from a peak of 2.3% in 2007 to 1.4%. The asset growth rate in 2021 was only 0.5%. In comparison, foreign banks in the U.S. hold a much larger share of the market, with their assets accounting for 12%. Furthermore, the profitability of foreign banks in China is relatively low. According to the Report on the Development of Foreign Banks in China 2021, the return on assets, ROA, for foreign banks reached its lowest point at 0.25% in the second quarter of 2016. In 2021, the ROA improved to 0.53%, but it was still lower than that of city commercial banks, 0.64%, and significantly lower than various other types of banks, including rural commercial banks, joint stock banks, private banks, and large commercial banks. The uncertainty of the Chinese Communist Party and the tense China-US relations cast a shadow over the prospects of foreign banks in China. Here are 2 points. The first point is that on July 21, 2022, the Financial Times reported that HSBC, headquartered in London, had established a Communist Party committee in its joint venture in China, HSBC Qianhai Securities. Prior to this, HSBC increased its ownership in the joint venture from 51% to 90%. This made HSBC the first foreign financial giant to establish a Communist Party organization. It also signifies the pervasive presence of Communist Party organizations, with even foreign banks that have a strong sense of superiority being unable to escape. No foreign institution in China can resist the extreme control ambitions of the Chinese Communist Party. The second point is that after Russia's invasion of Ukraine in 2022, the US and Europe implemented unprecedented sanctions against Russia. Banks in the US and Europe responded to the sanctions by announcing plans to end their operations in Russia. During a hearing on September 21, 2022, at the U.S. House Financial Services Committee, when asked if they were prepared to withdraw investments from China if Taiwan were attacked militarily, Bank of America CEO Brian Moynihan stated, "We will follow the guidance of the government. which we have done for decades with China. If they change their position, we will change immediately, as we did with Russia. The CEOs of Citigroup and JP Morgan Chase also made similar statements. This indicates that in the face of war and national security concerns, foreign banks in China actually have no choice. Due to the Chinese Communist Party's shift to the left and the increasing deadlock of policies, there is a significant possibility of Beijing taking risky actions, which forces foreign banks to find an exit strategy for themselves. In December 2022, one of the three major international rating agencies, Fitch Ratings, released its China Banking Industry Observation Report, anticipating that foreign banks in China would continue to face growth challenges in the coming years due to the potential sluggishness of the Chinese economy in 2022 and 2023. In fact, against the backdrop of the fluctuating Chinese economy, the Chinese Communist Party's strict regulation of foreign banks, coupled with the increasing confrontation between China and the Western world, it is expected that foreign banks planning to withdraw from China is not surprising.